Okay, thank you very much. Thank you, Patricio, for inviting. It's a pleasure. So yes, please interrupt anytime. There's no problem at all. So this is a joint work with Sumit Agarwal at the National University of Singapore, Andre Silva and Carlo X at the Federal Reserve Board, and myself at the IMF. So the usual disclaimers apply. So this is a paper about credit cards and how, especially we focus on credit card rewards program. We want to see how this program works and how sort of they redistribute market money in the credit card market. So we motivate the study starting from the consideration that we know from a very large literature in finance, and not only in finance, that individuals make costly financial mistakes when using financial products. Especially there is a large literature on that, as I said, that goes beyond financial product. There is a quite substantive body of evidence in financial market. Here we zoom in specifically on credit card markets. And for instance, there is a bunch of evidence showing that people tend to sort of incur over indebtedness, meaning so carry over larger debt compared to what is their ability to repay. And then there is also kind of pretty large evidence showing that, for instance, people repay their credit card debt in a way that is suboptimal, meaning that incur larger costs than the cost they could actually pay if they were sort of maximizing the way this sort of paying off cards in a more efficient ways. That's sort of the first step. The second step is that clearly the financial intermediaries, in this case banks, can design financial products that can exploit these mistakes. And so again, there is literature showing that salient and front-loaded benefits can be combined with shrouded and back-loaded costs. So this is basically what happens in a bunch of different markets, including financial products. If this is the case, meaning if people make financial mistakes and then intermediaries and banks can design products exactly to exploit these mistakes, then we should expect a redistribution in the market between people who tend to be less sophisticated, and we call it naive, to those who instead are more sophisticated. So the basic intuition that we have is that in the market there will be naive guys, and these guys will exactly incur the kind of financial mistakes that we described at the top of the slides. They will pay costs, and the other side of the market, there will be sophisticated guys. This guy will sort of behave in a way which is optimal, and this guy can actually rack in the benefit from, in this case, the reward programs. And so there will be some sort of redistribution between naive and sophisticated consumers. And this is again something which is, for instance, the seminal paper is by Gabel in 2006. So what is our research question? So we move, from this sort of body of evidence, and this body of evidence is mostly theoretical. The point is that if you want to examine this sort of redistribution in the market between naive and sophisticated consumers, from an empirical standpoint, you have to face a number of challenges. At least there are two issues that generally prevent applied researchers to go and sort of really tackle this issue of redistribution. One is that financial decision-making generally depends on a number of variables which are very hard to measure. So we need a setting in which we can sort of minimize the unobservable factors which can drive decision-making process by the consumers. On top of that, we also need a setting that give us very detailed granular data, both on the benefit of the product and on the cost of the product. So what we think is that if you look at credit card rewards program, this is a very good setting which can help us really understanding the distribution, because we have very good data and because the decision-making process is actually very simple. Okay? So we try to sort of ask ourselves three questions. So we look at the problem, first of all, from the consumer perspective. And if you ask the question if there is a redistribution across different consumers in the credit card markets induced by reward programs. We want to understand who benefits from credit card rewards, and we also want to understand who pays for it. And specifically, we want to go at the mechanisms, and we want to understand which kind of behavior, which kind of suboptimal behavior can actually explain this kind of effects. Then we sort of flip the problem, and we look from the bank perspective, so from a financial intermediary. And first of all, we try to understand if banks actually design financial products in a way that try to incentivize the adoption and use of this kind of reward programs. And we want to understand how banks make profit out of these programs. And again, this is a sort of a non-trivial question because it's not clear ex ante if banks makes profit throughout the whole distribution of consumers. In the final sort of set, yes?
I'm sorry. Can I ask something just to understand?
Yes.
And so, in general, so when we think about credit credit card rewards, so we think that this is like a two-sided market for the for Visa or like the brand, right? Not the bank. And so I thought like the main reason that these guys have like this rewards program is that you incentivize demand for using the card, right, as a payment method essentially, and then you charge the other side of the market, which is essentially the seller, right? So and then I have like two questions. It's like so one is like why why would the bank benefit from that? I thought it was from the benefit was for the brand of the card. And second is so why do you think that sort of the reason for having this credit card rewards is for trying to get surplus from naive consumers rather than the other side of the market, which are sellers essentially?
Oh, that's a good point. I can later on I give you a little bit of overview of how the rewards program work, but in a nutshell, you're totally right. Meaning there is one part of the market which is sort of the credit card issuers companies like the Visas and the Mastercard, and then the other piece of the market which we don't look at is the seller. So what we care here is just the bank, so the bank who originates the credit card, which could be, I don't know, JP Morgan or Bank of America, and the consumers who actually use the card. And we look at how much pay the consumers or how much gain the consumer in terms of rewards and cost of using the credit cards. And then we look at the profits that, let's say, Bank of America makes. In between, there are two steps. There is some of the profits that goes to the Visas and the Mastercards, and there are part of the costs which are borne by the sellers. Okay, so basically that's a swipe fee. Anytime you pay with a reward card or with a credit card, there is a swipe fee, and that fee is basically what costs the seller when you use the credit card. We don't look at that, and we only look at the profits that the bank made, because when you split, I guess, let me see, I should have it's the only slide for which I don't have an hyperlink, but there is a slide here. Okay, so basically this is what happens. I guess that's what you were saying, is that there is the merchant here and the merchant and the card issuer. Okay, and so what we are looking is what happened between the cardholder and the bank. But when there is this fee, there is some money that is paid by the merchant, and some money which stay with the card issuer. Okay, so we only look at part of the problem, which is the money that the reward that the card holder sort of pay or not pay, depending on, we will see that some people gain, some people lose, and then we look at what happens to the profit that the bank makes. So, for instance, here it's an example in which there is a transaction of $100. Okay, so that's what the cardholder pays, and then what the merchant gains at the end of the day is 97.5. So there are $2.5 which are sort of lost in the transaction. Okay, and so the $2 are this interchange fees that goes between the merchant acquirer and the card issuers, and then there is also some other fees that goes from the merchant to the merchant acquirer. And then the card issuer, which is our bank, so Bank of America, for instance, get $1 back to the cardholder. So that's the reward. So there is some parts of the money, of the fees in between, which we don't look, which is basically what the merchant has to pay. We only look at sort of the money, the transaction between the issuers and the cardholder. Okay, that was it. Where it was. Okay, so
Andrea, can I ask you?
yes.
So, concerning the rewards, who is Visa or MasterCard or the bank who creates these reward programs or these kind of programs?
Yes, let me.
Or both.
Okay, let me. Can I? So I will get back to that in a minute. Like the short question is that the bank as the reward program, and the bank decide how much to pay in terms of rewards. But let me get back to that in a second. So to sum up, the three questions we ask are like, one, on the consumer perspective, there is a distribution across naive and sophisticated guys. Second, how banks gain out of these programs and how they make profit out of that. And the third question is a more sort of macro aggregate question. We will see and we will show that these rewards are very large in terms of US dollar on a sort of annual basis once you aggregate up the money. And so we want to see, like, does this sort of redistribution across consumers make sense and is relevant if I aggregate up and look at redistribution across geographies in the US? So we actually can show that this program can actually exacerbate economic and spatial disparities across areas. There will be areas in the countries which will be dominated by sort of naive consumers, which will lose using credit cards, and some other part of the country which are dominated by more sophisticated guys. And therefore, there is not only a distribution within consumers, between consumers, there is also a distribution across geographies in the US. So let me get now to the reward program you were asking for. So reward programs are clearly very much sort of dominant in the Anglo-Saxon market, mostly the US, but also the UK. But it's they're getting some traction in Europe, and I've seen in countries in Latin America as well. So basically, what rewards program offer are some sort of benefit for every time you pay and make a transaction with a credit card. There are different kinds of benefits. There are cashbacks, meaning you get money back at the end of the month, which is proportional to how much you spend. Or you can get some sort of money back in terms of miles you can spend and convert in a bunch of things, or points. So we look at all these programs together. As a sort of a caveat, here you can see that cashback are dollar rewards and miles and points are non-dollar rewards. Like the data that we will use are provided by people at the Philly Fed, and they already make sort of the conversion between miles and US dollar and points and US dollar. So from our perspective, everything, cashback, mile, points, can always be converted into sort of a US dollar rewards. This is a very large market. Like in 2019, 75% of consumers in the US were using credit cards. And reward cards account for something about 60% of new card origination. For some banks, if I remember correctly, like Chase, nowadays only issue like rewards credit cards. They don't issue classic cards, no reward card anymore. And also, like the size of the market is huge. Like if you look at the largest US banks, which are the one that we use in our database, paid something about 35 billion in the rewards in 2019. And 35 billion is a very large market. Like if you have a sort of a comparison, the entertainment market, the entertainment industry in the US is more or less the same size. So we're talking about like large numbers. And as I said, these reward programs are specific of a credit card and therefore are decided by the bank. So Bank of America or Chase can design different reward program on different cards. There are different cards, like some sort of very card with very high fees that gives you a lot of rewards, and card which are sort of with very low fees, and instead of different reward programs. What we care about are the sort of what we call net rewards. So this net rewards is basically how much you make at the end of the month using the credit card, which is the difference between the actual reward you get, which is like the dollar amount in terms of miles, points, or cashback, minus how much you pay by using the credit card, And how much you pay using the credit card are the fees, which are attached to the card, plus any other fee you pay if you incur into sort of outstanding balances or late payment or so on and so forth. And also how much you pay if you carry over outstanding balances at the end of the month. Okay? So clearly, if you use the credit card, you spend $1,000, you pay back the $1,000 by the end of the month, then you basically borrow for free because there is no interest payment. Possibly you don't have any other fees apart your annual fee, and then all your rewards are more or less your net rewards. If instead you carry over some debt, you pay interest on that. Generally, interest rates are extremely high on credit card debt, and therefore your rewards are the difference between your net rewards are the difference between how much money you get in terms of cashback and how much you pay in terms of interest and fees, and this difference can be negative. Okay. The whole point of the paper is showing that these net rewards are not equally distributed across cardholders. So we want to see the distribution of these net rewards across different type of people, different type of consumers. So how we do that with the data? So as I said, like we look at the US market. And so we use the Y14M data from the Federal Reserve. So these are data that covers all large banks, so banks with more than 100 billion assets. And they cover something about 70% of outstanding balance on consumer credit cards. So if you look at data of the Consumer Protection Bureau and we look at the outstanding volume of consumer credit, we compare sort of our data, we cover like almost three-fourths of the database. The way the data are structured in the Y14 are monthly level account data. And there is this is very rich because there is information not only on rewards and how much interest and fee payments people have on their credit cards. We also know how much they spend and how much, how large is the unpaid balances at the end of the month. We know their credit limits, we know their FICO score, we know so we have information on consumer income, which is sort of self-reported, but still is good. And then we have information about where the people are located, the zip code level. So we can basically put cardholders on the map everywhere in the US, and plus a bunch of other information, but these are the key ones. So we have basically everything in terms of credit card account information and balances and rewards. We know some credit worthiness through the FICO score with information of people income, and we know where they live. And in the US, if you know the zip code, you can basically infer a lot about sort of demographics of the individuals. We use the data mostly as a cross-section. So most of our analysis is a cross-section, and we take one random month, which is March 2019. The reason is that, first of all, we want to stay away from the pandemic. So we don't go with more recent data because clearly, because of a lot of policies intervention, the credit card market has been hugely distorted during the pandemic. And also, we want to avoid any kind of month which is where consumption patterns are affected by festivities like Christmas or Thanksgiving or summertime. So March is generally a normal month. So far, we have this cross-section. What we are running is basically looping all our results through the 12-month and see and I guess we do it with a random sample so far, and the results are consistent. And so it's a cross-section of about 240 million consumers. And if you look at the descriptive stats here, you can see that basically we have an equal split between the reward card and classic cards. So it's about like 120 million cards each of the two types. We bundle the rewards card all together. Then at some point, as a robustness, we have different results for cashback cards, point cards, and mile cards. And classic cards are simply the credit cards that give you no kind of rewards at all. A couple of things to note here is that, and we'll come back on that later on, is that, for instance, if you look at the APR, so the interest rate tend to be lower on reward card than on classic cards. People with reward cards are generally have high FICO score, they have higher credit limit, and they're generally better kind of customers. Clearly, by construction, like rewards are positive with reward cards, and that's zero of classic card, because by construction, classic card don't give you any benefit. If you look at net rewards, however, you can see that more or less on average are Actually, they're exactly the same on average. What we care is again, how these are distributed across cardholders.
Andrea?
Okay, no, sorry. Yes?
Sorry, in the previous slide, you said that you cover 70% of the cardholders. Why are the other 30% outside this? Do you have any?
Because these are people, the 30% of, we cover 30% of balances, not of cardholders, but the missing 30%, but the balances are balances on credit card issued by mid and small banks.
Okay.
So for instance, my reward card with my credit union down here, it's a very small credit union, so my balances are not in the database. On the other hand, I have a Chase credit card, and my Chase credit card will be in the sample.
Okay, thank you.
So I also have a question, Andrea. Regarding these rewards, you said that they are converted, these miles or points are converted into cash or into money, so for the purpose of handling them all together. But I was wondering whether you can observe who redeems these points and who does, because I guess there could be also heterogeneity who effectively receives something versus just nominal rewards that you accumulate these points, but you never really exchange it for anything.
Yeah, that's a very good point. Like, let me give two answers. Like, one, I guess, once we see, now I was going to discuss how we compute these net rewards, because the data are very rich, but there is one limitation, and one limitation is exactly what you said. We don't observe redemptions. So here is how we compute net rewards. Net rewards is the card holder or card level in the month T. It's the difference between the reward, the interest paid, and total fees. Okay, so the point is that the reward variable is something that we don't observe in the data. In the data, we observe how much interest you pay in your credit card in a given month. Let's say $40 interest payment and like $8 of fees. What I observe in a month is the cumulative rewards in each month. But the cumulative reward, so let's say you have like 1,000 points, it's going to be like the 800 points from your previous month, okay, plus, I don't know, 300 points and 100 points that you redeem. The point is that we don't observe all these, so we need to estimate the rewards from the data. Okay, so that's one limitation that we have. And the way we estimate the reward from the data is we compute a card-specific reward rate, which is basically the ratio between the change in cumulative rewards divided by the purchase volume. So if you assume that redemption are 0, then the reward rate is correct. Okay, this formula is it gives you the exact card-specific reward rate. We know that every card has a specific reward rate. Like, I don't know, the Amazon card give you like 3% reward on average. Like some other card give you 2%, some give you 1.5. So we try to estimate the card-specific reward rate. And to try to get around the problem, we estimate, and we have like a cluster of credit cards at the individual product level case. So basically, we cluster all the cards issued by the same bank, the credit card type, meaning we split miles from cashback from points. In the same card network, Visa versus MasterCard, for instance, by reward type, by fee type, and by fee level. And then we estimate a reward card rate, which is basically the median or the card-specific reward rate. And then we use this estimated reward rate on the purchase volume that you observe to estimate the rewards. So to answer, so that's what we do, and so we get these rewards here. We are quite confident that we get a decent number, because then if you aggregate this reward number here, we get statistics which are very similar to which are produced by the Bureau of the Consumer Finance Protection Bureau. So that's I guess we make it confident. But the point is that since we don't observe redemption, we can't really go into the question you were asking. So that's one key limitation that we have. There's actually a second limitation here, which we only observe sort of monetary rewards. So we observe cashback, points, and miles. Clearly, credit cards comes with non-pecuniary rewards, like access to lounges and a bunch of other things, like you are in some sort of status membership and a bunch of other things that we cannot really observe. That said, those non-monetary rewards, if anything, would make our results even stronger. We could make net rewards even larger. So if anything, we sort of underestimate the value of net rewards.
Andrea?
So yes?
There is another caveat, I think, that is that in general, when banks use these reward rates, these reward cards, they use them to attract the higher income clients, which in time they use another services of the bank.
Yes.
I don't know, for instance, the investments in shares in the market, of these things like that, and you're not including that in the cost, right? The fees they pay other fees that are why they get those cards. That's why the banks issue them.
Yeah, I see what you mean. I guess so. The issue is cross-selling. It's true, meaning banks do a lot of cross-selling, and one can think that rewards cards are a good way to attract consumers and then sell something else. I see your point. Formally, what we really care is how much. So our question is how much you make or how much you lose using the card, simply using the card. So the fact that then you have I don't know, a mortgage attached to it, or an auto loan or something, it's true that there is a cost to that, but then you have the benefit because hopefully you need a mortgage or you need an auto loan. So moving that cost here, it would be a little bit sort of, I don't think it's a fair representation unless you think that if they are selling, let's say, an auto loan at 7%, while this guy could have get an auto loan at 4% easily somewhere else. But then it's something we don't know. So what we know is that, first of all, we don't observe it, but even if we were able to observe that the person would get an auto loan, and that would have a cost, but that's the cost of that product. Here we just look at the cost of this product. Then it's true that implicitly there could be other costs attached to that. But then it's very difficult to quantify and to see what is sort of a real cost or not. And then actually, we'll come back to that later on, because I guess people clearly has in mind that banks design this product to do cross-selling. And sometimes people were thinking, especially for people who have very high credit worthiness, basically banks don't make any profit from these guys because these guys are very good, they pay on time. And so people tend to think that banks make profit on these guys only because they sell something else, like two mortgages or wealth management services and so on and so forth. What we show in the paper is that banks actually make profit throughout all the distribution of consumers. So they don't really need all this cross-selling to make those business model profitable. And I guess there was, I guess CNBC did a video citing also this paper, but then they interviewed a bunch of people from the industry, and they were proudly saying that they make profit, for each single credit card. They don't need anything else. Everything is profitable from their point of view. But I'll come back on that. So what we do in practice, so let's start look at the consumer perspective. So here we want to look at the distribution across people, across consumers. So what we do, we basically compare net rewards between a reward card and the classic cards, okay? So that's the comparison we do. We want to do the comparison as tight as possible. So we want to compare a reward card with a classic card, making the comparison as tight as possible. So we want to potentially, what we want to do is basically comparing, let's say, me with my co-author Andre. We live in the same zip code. We have more or less similar income. We are very much similar. Let's assume that I have a reward card and he has a classic card. That's the kind of comparison we want to do. We want to see my net rewards versus his net rewards. So in practice, we compute these net rewards of the card I, and that's a function of a dummy which separate the classic from the reward card. We control for a sort of set of fixed effects, which are the interaction between the bank fixed effect, the zip code, the percentile of income, and the percentile of the FICO score. So we look within the people which are in the same FICO percentile bucket, which are in the same income brackets, which we live in the same zip code, and which are a credit card issued by the same bank. Then we also have controls at the credit card level. So we look at, again, cards which have very similar credit limit, amount past due, similar age, and a bunch of other stuff. And then we have consumer level controls, again. Standards, so here we have like bankruptcy indicator and the number of credit cards that people has and so on and so forth. What we are interested in is, as I said, looking at the redistribution. So how much rewards are different between clearly classic rewards card and how these sort of rewards are distributed across individuals. And so we look at the distribution of reward card across the FICO buckets. Okay, so we interact our reward card by a dummy, sort of a 4 categorical variable, which we separate out the subprime guys, the near prime guys, the prime, and the super prime guys. And we measure FICO score 1 year before our data. So the FICO score is predated, and then we want to see like the distribution of the net rewards across people with different FICO scores. Okay? And the idea is that people with low FICO score will sort of be less sophisticated guys, and the people with high FICO score will be more sophisticated guys. But then we will have a second part of the paper in which we provide evidence to substantiate this claim. And here is our
Andrea,
yes.
Can you go back to the previous slide?
Yes. Yeah.
So I understand you're trying to control for as much observables as you can, but there's still a self-selection story there that you're not taking into account. I look at my own decision of taking credit cards, right? I used to I travel a lot, so there's a lot of credit card characteristics that I take into account, but I usually go with a card that is aligned with an airline or something like that, and that's me. That's my unobservable preference with that.
No,
right? Go ahead.
No, that's a point very well taken. So what we do is that we have we start with that because we want to maximize sample and so on and so forth. But then we narrow it down more and more, and I guess there is a table later on in which we look at within borrower. So we have borrower fixed effect, and then I just look at the comparison between card type. Okay. I'll get back to that.
And
here are yes.
Also, the second question. So why does the decision of labeling sophisticated and non-sophisticated based on the FICO variable instead of I don't know, like high FICO, low FICO guy, or I don't know. I mean, it's not. I mean, the FICO value of the variable may be also related to the income of the consumer, right? So,
yeah, let me don't spoil too much of the paper now. Let me go, but that's a key point. So what we do, like at the research design, done in a way that we care about like distribution across FICO score to some extent because it's the key variable that we have, and also because we think it's a good measure of sophistication. Let me give you an answer in short, and then I come back on any of these points. First, like FICO is generally used quite, often as a measure of sophistication. It's a good measure of sophistication. We then have a part of the paper, and I'll come back on that, in which we show that we can actually show in our data that it's a good proxy for sophistication, meaning we can show that people with low FICO score tend to make much more financial mistakes on these credit cards than people with high FICO score. So we can actually show that. And it's also true that people tend to think that FICO is correlated with income. I'm not saying it's not true. What we can show is that, first of all, FICO and income are not that much correlated, especially if you go at the individual level, the card level. And we have part of the paper, in which I'll come back in a second, in which we can actually try to disentangle the two stories. So it's a story of distribution across income, or it's a story about redistribution across sophistication. And our bottom line, you will see, is that clearly income plays a role. It's also true that there is some redistribution going from the poor to the rich. But even if you take account the income story, it's still a story about sophistication. So sophistication is still important, but it will become clear in short, I hope. Let me start by showing the results.
Andrea,
Yes.
sorry, can I jump in for a related question
Sure.
about the FICO score? So with the FICO score also sort of correlates with, credit constraints probably for the consumer, which also correlate with using the card as a borrowing, for borrowing and not just a payment method. And then, these guys, low FICO guys can, make more mistakes, not because they're less sophisticated, just because they're using, they might not be mistakes, right? They're just using the card, for borrowing. And if they're constrained, they can just
Exactly.
not pay it back or something like that, right?
Exactly. Look, that's a good point. It's a perfect point, like, to illustrate this chart here. So here we plot the data as they are. So this is basically raw data. We compute this average net reward in a month, in each month, and then we plot the net rewards for classic card, the dashed blue line, and for rewards card, the solid red line. Okay? And on the y-axis, you have the credit score. So what you can see is that by construction, the rewards on classic cards are never positive, they're always negative. And clearly they are more or less increasing with the FICO score, because these people tend to sort of, carry zero balances, they don't pay interest, they just pay the fees on the credit cards. If you look at the rewards card, you have this sort of S-shaped distribution here, in which there are a group of people, this high FICO score actually benefit from using the card, so their rewards are higher than how much they pay in interest and fees. But most of the guys, all these people here, instead pays from using the reward card. So all these guys lose money, so their interest payments and fees are larger than how much they gain in rewards. That's per se, I think it's an interesting fact. So the fact that showing that a huge part of distribution on average loses from using the rewards card. I guess your point you're saying is that, for instance, let's look at these guys that stays here, the 660. Okay, if I compare the reward card with the classic card, one could be tempted to say, okay, but the guy here would be better off with the classic card. We are not saying that. Okay, we're not making here this kind of comparison, because it could simply be the case that there are benefits from having a reward card compared to a classic card. The one, for instance, would be simply the fact that I can borrow. Okay. So if I have a reward card, I can maybe have and they want to borrow because they want to have access to credit, and therefore I'm very happy to pay, let's say, this additional, what is that, like $16, $17 per month more, because it's the cost for me to have access to credit. That's fine. What we show in the result, that we try to do our best also to sort of shut down this channel. So here I told you that we control for a bunch of things. We also control for sort of for the credit limit and how much you use of that credit. And in that case, basically, we are holding credit constraint constant, because we're using credit card. Let's say they have both of them. We have 5K credit limits, and people with the same amount, the same size of outstanding balances. So those people, for me, have the same sort of, they are similarly financially constrained. But it's true that there are this sort of consideration to keep in mind. So these are the results that we have. So with sort of the baseline specification, when we look at within bank, ZIP, income, and FICO buckets, having a reward card is associated with $3.5 more in terms of net rewards compared to the classic card. And if you split this coefficient across the FICO score, you can see that the subprime and near prime guys lose money using a reward card compared to a classic card, while the prime and especially the super prime guys are much better off when they have a reward card compared to a classic card. And you can see that, this is basically $16 per month. So if it's kind of a large, it's not a small amount. These are dollar amount. And these guys here, the subprime guys, lose about $6 when they use a reward card compared to a classic card. And you can also say, okay, this is why you pick like these 4 buckets. We do the same thing on a continuous distribution. And so here is basically the estimated results when we have a continuous variable, actually not a continuous, but we look at percentile of FICO score, right, in the 4 buckets. And this is the same chart as before. So the people here, this is simply the difference, or the coefficient, the difference between the reward card and the classic card conditional on the FICO score. And you see that this is negative up to basically the subprime and the near prime, and become positive for the prime and especially the super prime guys. So again, this is basically the $16 that I shown you before. Yeah. Then you can do here. I go back to what I guess Patricia's comments were. We can look at within the same credit limit, and we can also look at within the same APR. Again, when card differs in terms of APR quite substantially. So I compare, so here I'm basically looking at people and credit cards given to people which are very similar credit worthiness as reflected by the APR and with the same credit limit. And again, the results are the same. As you can see, like sample size become much smaller, and the dollar amount also becomes smaller, but the results still go through. Then we do, to answer one of the questions before, we look within borrower. So here I have the borrower fixed effect, the cardholder fixed effect times bank, and you can see that the results are still there. So here in this case, like preferences, individual preferences should be controlled for, and they still find the effect, sort of the same shape of the distribution. Then we can look at, what's the effect on the components of the reward. So we look at the rewards, interest paid, and total fees. And here the only point that we want to make is that in sort of economically, fees are kind of irrelevant. So our results is not driven by the behavior of the fees. Our results is mostly driven by the interest components. So the low reward people, the low FICO score people, the naive guys, tend to carry higher outstanding balances, and therefore they pay high interest rate. And so you can see that there is this difference. So the difference you see in net rewards is driven by the differences in interest paid, and this difference becomes much smaller here. And the other component is the amount of rewards you get. Clearly, by construction, the classic card don't get rewards, while rewards are an increasing function of FICO score, because people with high FICO score generally spend much more. So if you combine the two things, you basically get, if you combine these two charts here, you get the same sort of picture that we had before. We can do that in a regression framework. It's exactly the same. You can see that in dollar amount, total fees don't really make much of a difference. What you can see is that instead rewards are linearly increasing with FICO score, while interest charges are especially larger for subprime and near prime when you use a reward card compared to classic card, which instead they decline when they use for super prime guys. Then to give a sense of how large the things are, what we can sort of first of all compute the annualized distribution, which is about like $15 billion, and we can see that cardholders with negative net rewards pays $4.1 billion using reward card, and cardholders who instead have positive net rewards gain something 1.3 billion, and the difference is basically bank profits. Okay? If we try to understand who pays for this 4.1 and who gains this 1.3 billion, we can see again that there is a distribution going from the low FICO to the high FICO people, because of if you look at the amount of money that cardholders pay to the banks, so the amount of money paid by people with negative net rewards, you can see that most of this money comes from subprime and near prime borrowers, okay, 1 and 1.6 billion respectively. If you look at the 1.3 billion which is earned by the guys with positive net rewards, most of that goes to the prime and the super prime cardholders. So it seems that this is a distribution. So the guys who pay tend to be at the lower end of the distribution, and the guys who benefit are on the high end of the distribution. Then we get to the interpretation that somebody already raised. So how we interpret these results. So here I already said that our punchline is about sophistication, but I guess what people had in mind, and the question make it pretty clear, is that people tend to think that instead that it's mostly a story about income. It's about poor people paying for the rich people, and there's a lot of there's papers showing that. And there's a lot of discussion in sort of in the popular press as well. So here there are some example of how credit card companies reward the rich and punish the rest of us. How much credit card rewards cost the poor and such. So how we tackle the problem here? First of all, as I said, like credit score and income are not very much correlated. So here there is this is a paper by colleagues at the Federal Reserve Board that shows that. And we can also look at the data. Like for instance, if we look at here at the FICO distribution by income. So here the distribution of FICO score, the red line is our full sample. Okay, and then we look at the distribution of FICO score in the lower income tercile, which is the dash light blue line, the middle income tercile, and the top income tercile. Clearly, you can see the top income tend to be concentrated at the high FICO score, and the lower income tercile are more concentrated at the bottom of the FICO distribution. But still, there are people with lower income with very high FICO score, and still there are high income people with very low FICO score. So, okay, there is a correlation, but it's not a one-to-one correlation. There's a lot of exceptions. Second of all, like if we do the same kind of charts I showed you before, so again, without any sort of manipulation of the data, and we plot the average monthly net rewards, rather than across FICO score, we plot it across income for reward card and for classic card, you can see that basically there is no clear association. At the very high end, you see clearly that there is an increase, sort of rewards are higher for people with very high income. But let's say if you focus on the bulk of the distribution, it's not true that higher income people get higher rewards than low income people. So that's to make the case that income and sophistication are not exactly the same thing. In practice, what we do, we also do exactly the same exercise that I shown before, but we do that within income buckets. We do at the low income, at the middle income, and the high income deciles. So basically, we take this chart here, obtained by this regression here, and we replicate that in 3 separate samples: low income, middle income, and high income. And what we get is this chart here. And you can see, like, if you look at the lines, they show exactly the same pattern as before. So people at the low end of the distribution lose money using reward card compared to classic cards. People at the high end of the distribution instead earn money when they use the reward card compared to when they use the classic cards. Results are sort of larger for the high income, so the distribution is much larger, but that's the kind of results we get. So that seems to suggest us that income clearly is, we're not going to say that income is irrelevant. What we're saying is income is not the entire story, and sophistication matters. So FICO still plays a role, even if we look within income brackets. So these are the same stuff shown in the regression sample. We can also do the same thing. Yes.
Andrea, the income is at the zip code level, or do you have a measure of income at the individual level?
No, it's income at it's individual, it's a cardholder level. As you have seen from the chart I showed you before, like it's a little bit noisy. So I would say like we're not 100% confident at the like one by one, but that's the reason why if you look at terciles and I guess and then we split the sample, then we are more confident that we are sort of allocating people in the right buckets, because it's self-reported. There could be problem and noise, but
okay.
On average,
okay, you have self-reported measure. Okay, yes. Thank you.
Okay, so that's what.
Can I ask something? Sorry. So just to understand, so the so people that make mistake like low FICO, do you know if they made these mistakes like once, or like it's all the time?
That's a good point. That's a very good point. Let me get now to the mistakes, and then I guess we don't answer your question. I mean, I think it's a very good question. It's the learning part. We could do, I think, but I think it's a different paper, but I'll sort of elaborate a little bit more now that we go into the mistakes. So here our punchline is that, okay, we show the distribution. There is a distribution from low FICO to high FICO. This is not explained, at least entirely, by income, so there should be something else. So FICO should proxy for something else. As I said, like FICO generally captures behavior associated with lack of financial sophistication, and therefore is pretty widely used as a measure of financial sophistication. Here we cite just one paper from the co-author of us, but just to reassure you, there are other papers not co-authored by any of us which do exactly the same use of FICO as a measure of sophistication. That said, like, we ran 2 tests to show that indeed FICO score are associated with financial mistakes. First, we look at over-indebtedness. We want to show if a reward card induce higher spending by consumers, and this caused some of these consumers to have higher unpaid balances and incur higher interest rate and fees. So in practice, what we do a diff in diff, in which we could look at similar consumers, and we look at after an increase in credit lines, what happens to their consumer pattern when we compare reward card and classic cards. I'll come back on that. The second exercise, we look at suboptimal repayments. We have a way to look at, how payments are misallocated, and that goes back to the fact that, this is a good setting to move from theory to empirics, because it's very simple here. It's very easy. There is an optimal rule through which you can repay the card. So it's very easy for me to identify the kind of mistakes that people make. And so I want to see if these mistakes are higher for rewards than for classic cards. And again, if this is more common for low FICO individuals. So let's start with over-indebtedness. So again, here we want to see if rewards card induce people to make financial mistakes and to spend more. And again, this is something that people are generally discussing. Like there are a few excerpts from a bunch of sites on that advertise credit cards, and they say, for instance, the potential for travel perks, cashbacks, and bonus points would cause you to spend more than normal, potentially resulting in higher fees and interest on those purchases. Okay. If you find you're consistently overspending in the hopes of getting rewards, it may be time for you to stop using credit cards until you train your brain to think differently. So it's exactly something that, I guess everybody is in mind. I guess, each of us, when we have the rewards card, is be tempted to sort of spend because, we get a bunch of rewards, we get the points, we can fly free somewhere. So what's the empirical approach? Here, the good thing is that in the data, we can see when there is an increase in credit limit in the credit card. So let's say when the credit card limit goes from $5,000 to $8,000. We can also differentiate where the credit limit is initiated by the bank or by the consumers. So if you demand for that, or the banks offer that. The bank initiated is basically when you get an email from the bank saying, oh, your Chase credit card limit is gone from $5,000 to $6,000. So we only use the bank initiated credit limits. Clearly, we are not making the claim it's strict exogenous. Clearly, banks respond to incentive, and the way they design this credit limit is clearly not exogenous. But it's good enough for us to design this diff and diff. And then we look at the differential spending and borrowing between rewards card and classic cards. So basically, we look at individual, or actually cardholders, which in the same month of March 2019, they have a bank-initiated credit limit. There will be some credit limit increase for reward card, some credit limit increase on classic card, and then we compare spending for these two cards before and after. So we look at a 12-month around March 2016. So we go to September 2019, so 6 months post, and we go to October 2018, 6 months before. Okay. That's again another reason why we use March, because here of diff in diff, we don't want to end into the pandemic. And here is the result. So basically, it's a very standard regression. We look at the change in spending as a function again of the dummy for the reward card interacted by the FICOs buckets, fixed effects, card control, cardholder control. We have about 1,200,000 observations. What happens is that, first of all, we can show that this increasing credit limits increase spending more for reward card than for classic cards. So actually reward card tend to induce people to spend more. What happens is that you increase payment, but also you increase unpaid balances. So people tend to become over-indebted, okay? Because it's not simply it's simply a situation of you spending a lot. It's a situation of you spending a lot and not being able to repay everything at the end of the month. So you end up with unpaid balances, and therefore your interest payment goes up. What is interesting, however, is how this average pattern is split across the FICO score. If you look at the very good guys, the prime and the super prime, they increase their spending capacity. Let's say here is going to be on average $160, but they basically repay back all of that money. And in fact, their unpaid balances don't change at all. Okay? So these people, they get the increasing credit limit, they go out, they spend a lot, they repay at the end of the month, they cash in the rewards, they're basically better off. They gain from the increasing credit limits. Look at what happens to the subprime and near prime guys. This guy has the same exact behavior. They get out and they start spending. They increase their spending by $60 or so. What happens is that actually they don't have any capacity to repay. So they're just over borrowing, and they end up spending balance with an increase in unpaid balances, which will cost them interest. So what happens is that, okay, on average, a reward card induces people to become over-indebted. But what happens is that all these mistakes are done by the people with subprime and near-prime FICO score. These mistakes tend not to be done on average by people with prime and super prime FICO scores. So that's the first piece of evidence that tells you that FICO score is a good approximation of financial sophistication, because this kind of financial mistakes, so becoming over-indebted, tend to be associated with reward card, but only for people with low FICO score. The second exercise is we look at this misallocated repayment. As I said, like here we look at a consumer would have multiple cards, okay, with the same bank. And because in this case, I can actually show, first of all, I can observe how much they repay and the way they repay their credit cards. And also I know by construction, which is the optimal rule. And the optimal rule when you have multiple credit cards is you pay the minimum payment on all your cards, and then you start repaying in full the one with the higher interest rate, the higher APR. Then you move to the second one with the highest APR, the third, the fourth, depending on how much money you have to repay. So you allocate your repayment, ranking your card by the APR. Okay, that's the optimal rule. So what we can do, I can compare the optimal rule with the actual repayment that I observe in each of the cards. And I can compute the share of repayment which are not optimal, okay, the misallocated one. Okay, I can compute the difference, let's say, between the optimal rule and the actual sort of repayment you do. And the share of payments which are made incorrectly on a cheaper card versus a more expensive card is a measure of financial mistakes. I can do that for each kind of borrower. First of all, I can show again that the share of misallocated payments is a decreasing function of the credit score. That tells you again that the FICO score is a good measure of financial sophistication. Second of all, like we do in a regression setting, we can see same regression our baseline. Mistakes are more common on reward card than on classic card. But again, if I split across FICO score, mistakes are always concentrated in subprime and near prime guys. They never happen on average for prime and super prime guys. So again, this is second piece of evidence, and this is true if, here we condition on a bunch of more and more restrictive sample moving from column 1 to column 6. Here it's a very restrictive comparison, and we can still see that financial mistakes are made by people with low FICO scores. The final piece of evidence is that we look at how these payments are done, and there is an AER paper by Cathergood and co-authors that basically show that generally people tend to repay credit cards using what is called a balance matching heuristics. So if you have to repay your credit card, some way you are scared by high balances on your credit card. So if one of your credit card has $2,000 outstanding debt, another one is $200, you tend to repay the $2,000 because it's sort of a large balance, even though maybe the $2,000 carry an interest rate of 17% and the other at a higher interest rate. So this is a standard kind of mistakes that people make. So here what we do, we compute the share of payments in a credit card, and we have like the optimal share of payments. Then what should be the payment done with the balance matching heuristics, which is a standard kind of mistake that people make, and the actual share of payment we observe in the data. Then we plot these three things across the 4 FICO buckets. Clearly, we have everything done in a sort of more in a very complicated table in the paper. It's a chart that summarizes the results. What you can see is that if you look at near prime and super prime guys' actual repayment, they are very similar to this balance matching heuristics. So again, a standard kind of financial mistake that people tend to make. If I look at prime, especially super prime guys, the actual share of payment is much closer to the optimal rule. Okay? So it's another way of looking at how people make financial mistakes. So the next step is, I'm running out of time, but this second and third part are much shorter. We look at the bank perspective. So we want to see how much money makes a bank out of the credit cards. So here to compute bank's profit and loss, we just change a little bit, and we have to look at interest paid and total fees, which are part of their income, and then part of the cost of the rewards. But if you look at from the bank perspective, banks make also money from the interchange income, which is a swipe fee that you pay when you use a credit card, and they have also costs from charge-off and from unpaid balances, okay, that cost the bank. We don't observe everything. We have to sort of do assumption on the interchange income. We don't know the fee for each of the cards. We basically assume 1.5 for classic card, 2.5 for reward cards, and we do robustness around that. And we compute sort of the interchange income using this percentage, this rate times the purchase volume. And then we set the weighted average cost of capital, 5% for all the banks. We can do robustness, trying to do some sort of bank-specific cost of capital. But then we compute bank profits. But the first question is, do banks sort of kind of try to attract consumers into reward cards, knowing that people make financial mistakes? And here we have some evidence that suggests that. If you look at APRs, you can see that APRs are much lower for reward card than for classic card. And it is true not only for the sort of high FICO score, it's true also for the low FICO score. So if you look at the distribution of APR, it seems that banks tend to sort of give lower interest rate to classic card compared to the reward card than for classic card. This is true also in the standard regression setting in which we control for the same stuff. So this is basically, it's not entirely different but unobservable, but it's even if we narrow the comparison, it's still there. Then what happens to the profits? What I was saying before, when somebody asked about cross-sellings, basically banks make profit throughout the entire distribution of the credit score. So banks make profit for the low FICO individual, and banks make profit out of the high FICO individual, more for reward card than for classic cards. So reward cards are always profitable. And again, we do that in a regression setting, and it's the same stuff. Especially banks make most of the profits at the people at the middle of distribution. And what happens is that we can sort of look at the source of the profit from the bank, and you can see that basically banks make profit through interest income for people who tend to be on the left-hand side of the distribution, though these are people who basically spend more than what they can repay, so they carry balances and they pay interest on outstanding balances. While if you move to sophisticated guys, banks make profit mostly through interchange income. So these people, you can see that the more sophisticated the people are, the less interest they pay, which makes sense because they don't carry outstanding balances. So basically, they're not revolver, but they pay a lot on interchange income because their purchase volume is very high. And you can see, as I said before, basically fees don't really matter in economic terms. They're not that relevant. So that's on the bank side. The final part is on this, what happens in terms of more macro level, in terms of spatial disparities. Here we plot, we look at net rewards, and we can compute net rewards at the zip code level. So we aggregate all our data at the zip code level, and we can compute the net rewards, where like the darker, meaning the more negative the net rewards are. No, sorry, the darker, so the lower the net rewards are, the higher, so basically more positive. Okay? While the lighter, meaning you have much higher costs. Okay, so much lower net rewards. And basically, if you look at the map on the left and then you compare with the map of the right, which is the distribution of FICO score, again across the US zip code, you can see the very stark correlation. Okay? So it's a very stark correlation between areas in which there are a lot of very sophisticated guys and the fact that there are higher net rewards, and where people tend to be much more naive and less sophisticated, people tend to pay much more in terms of like negative net rewards when they use the cards. So it's a very strong correlation, at least visually. So what we do in the data, here we look at the distribution and we want to see like if net rewards are somehow associated with some characteristic of geographies. Okay? So we want to see there is a distribution that goes from some specific areas of the country to some others. And then we look at characteristics at the zip code level. We look at the average education, we look at the average income, and we look at the share of Black population in the zip code level. And if you look at column 1, 2, 3, and 5, what you can see is that here we are looking at net rewards as a function of this variable. And you can see that net rewards are associated with a higher education, higher income, and a lower share of Black population. So that sort of shows that there is a redistribution across geographies, with money going from low educated to high educated areas, from low income to high income areas, and let's say from Black to white population areas on average. Okay, so there is this evidence of redistribution, and that sort of suggests a channel through which net rewards can exacerbate spatial inequalities. This could be a channel through sort of financial sector can make wealth disparities larger. So all this literature about like, how the financial system can make wealth inequality even larger, that could be one potential channel. What we're also saying is that, however, this is very much driven by sophistication. If we do the same regression and we control for the credit score, and again, assuming that the credit score is a good approximation of financial sophistication, of the average degree of sophistication in the area, basically what you can see is the result goes away. So clearly there is this distribution, which we're very descriptive. But what we're saying is that these results tend to be driven by differences in the degree of financial sophistication across areas. So let me conclude, it's too late. So we do three things. We look at redistribution in credit card markets across consumers, find the sophisticated individual, make profit using reward card at the expense of more naive ones. Our results are not driven at least entirely by income, but are driven by differences in financial sophistication. And we show that because we can see that the reward card induced overspending, causing naive consumers to have higher unpaid balances. We can also show that naive consumers had higher misallocated payments on reward card and follow generally a costly balance matching heuristics when repaying their credit cards. From the bank perspective, our results suggest that banks use low APR to sort of induce consumers into using reward cards, and then they make profit out of that. They make more profit on reward card than on classic cards. That said, banks make profit across the entire FICO distributions. Finally, we show that once we aggregate up, the distribution induced by reward card is large in economic terms, and this contributes to a transfer of income from less to more educated, from poorer to rich, and from high to low majority areas. That's all. Thank you. Yeah.
Thank you, Andrea. So if we can take questions now. So we have 15 more minutes.
So I have one. Thanks, Patricia. So I was looking at this result about the naive consumers engaging in this balance matching heuristic. So if I remember correctly from the descriptives, the reward cards actually have lower interest rates in general. So, but there is also a distribution of interest rates based on the FICO score. So, is it because they don't actually pay the reward cards first, despite spending more on that, or is it because in their case the interest rate is worse anyway? So even if the reward cards on average have a lower rate, for the low FICO score consumers, it's still worse or something like that. So listen, my question is, how would you decompose this mismatch in payments for these low consumers? So how this is it because of the rates or because of the card they're choosing?
Yeah, no, I think here what we so good question. Let me think a little bit. So the way we compute it is that no, I think it's not a function of the rate, because we look at, you know, how no, because we look at it's difficult to, in this chart actually it's not shown, but in the table that we have in the paper, we do this exercise when we look at payment on rewards card and payment on classic cards, and then we can see that the same kind of behavior it's observable in the two samples. So what we are saying is that then what we show here is the reward card. In the reward card is stronger. Okay, so here we're looking at share of payments on the reward card. So the year basically we're on average. So if your concern is that this card on average are cheaper than the other, so here we're only looking within those. So I think it's not driven by the difference between the two. In the paper, basically, we have results in which you can replicate this chart for the classic card. And if I remember correctly, the picture on the reward card is more striking than the picture on classic card, which is consistent with the fact that financial mistakes clearly are concentrated here than compared to the prime and super prime, but are also concentrated more in the reward card than in classic cards.
Thanks.
Yes.
I have a question.
Yeah.
Oh,
Patricio, ponga orden.
Yes.
Yeah.
So let's raise the hand. So Pablo goes first, then Alejandro, I guess,
Okay.
and then myself, I guess.
Thank you. Andrea, just a brief question. Let's say that we care about redistribution from naive to non-naive people, poor to richer, and so on. So I guess that your findings makes a strong case for financial education in the first place. But what about interchange fees? Do you think that this should leave more countries to regulate? I mean, I know the experience of Australia that has regulated them way back. So maybe if you do the same type of analysis there, you would find something different. What's your view on this? Thank you.
Oh, thanks. It's very useful that you made the question. I think it's slides are often prepared for like academic audiences, and instead the central bank, I guess the issue is more on the policy side, and so we speak to that. So we have something in the paper, not too much. We have a couple of like op-eds in which we try to be a little bit more explicit on this discussion about policies and what should do. I think, yes, the way I would read the paper is exactly the way you were suggesting. So I guess the first order takeaway for me is that this result suggests that investing in financial literacy and financial education is a no-brainer. And that, I guess, it's indisputable, and this is another piece of evidence that would support that. That said, I wouldn't say that this resolved the problem, and there is a lot that one could do in terms of like regulating the market. And I think, let me step back. I think we don't go that much into policies, in the sense, I think, because to argue about that, I think we would need a little bit more in terms of, we would need some sort of welfare analysis that we don't have. And that goes back to Patricia's points about like, yes, it could be that those people are paying, but they're willing to pay because there is some access to finance issue that they or still better that payday lending. Okay, so maybe the alternative is a payday lender. So still better to have a reward card and pay like 24% interest rate than going to a payday lender and pay 100%. So for that, we would need something more to answer. That said, with that caveat in mind, I think we can still say that some sort of policies that, in our view, bring more competition in the market, in the interchange market, would work. And I guess that's exactly the kind of debate that there is now in the US. So there is a regulation discussed by more than a year in Congress on that. There is part of the regulation which was more on hidden fees and such. And then I guess that went through. Now there is sort of bipartisan proposals to induce more competition in the, let's say, among like Visa, MasterCard, and credit card issuers, basically putting a cap on interchange fees. Okay, that's the idea, and that would increase competition. I guess it's super. If you look online and look at what people say, like there are like bank lobbies which are super against that. There are consumers lobbies like saying that basically politicians now want to kill points program and reward program, and people are incredibly upset of the fact that all of a sudden they will not be able to go to lounges and travel free all around the world. But in a more sort of practical and pragmatic view, like if you look at, for instance, the European market, the European Commission did that. So there is a cap on interchange fees in Europe, and the market, and in fact, you see that still there are reward program, but the size of rewards in Europe is much smaller. Here, literally with my Amazon Prime card, I get 5% cashback every time I buy on Amazon. In Europe, there is no way somebody gives like 5% cashback. So I think, trying to reduce the size of the reward program clearly would help. In the sense that we can really see that the distribution is pretty big. It goes clearly against one specific kind of consumers, which tend to be the weakest one, and on top of that, it also creates sort of pretty large redistribution across the geography. So I think, yeah, the bottom line is that the regulation could help.
Alejandro?
I was going to make actually the same point that Paolo just raised. So I guess the interchange fee question is already covered. But I would like to ask something maybe not that interesting, but I'm wondering if you were able to see any difference between the different types of benefits or reward benefits that you mentioned at the beginning. If there's any difference in your results considering cashbacks, miles, or points? I was wondering if you see that there is any relevance in separating those rewards in the way you mentioned. That's it.
Yes, I guess you're right. You made the point earlier on. I forgot to go into that. I don't have the table in the slides. I have it here in front of me. Like I think our results are much stronger, let's say, and much more visible when you look at cashbacks. And to me, it makes sense because it's exactly where you immediately see the benefits, and cashback is something you cash in. I don't know anybody who has cashback and just leave it there. I know people who have points on miles and they just sit there idle and nobody redeem them. So I think it makes sense to see that the results are much stronger for cashback than for miles and point cards. Actually, what's interesting, if you look at miles, sort of you see that actually what is even more interesting that if you look at the benefit, so the benefit part are driven by cashback, because it's are people that spend a lot and you get the benefit and such. For miles, you see much bigger you see the results are much bigger on the low end, meaning that the losses are much higher for these low FICO people, which makes sense because that the kind of people that maybe, yeah, they could get some miles using the reward card, but maybe they're not the people which are always able to spend those miles. Meaning a low FICO people, how many trips can do compared to a high FICO people? Again, I know I said that FICO and income are not one-to-one correlated, but they are correlated. So low FICO people maybe are less opportunity to redeem their miles, while high FICO people are much more able to redeem miles. So yeah, there are these kind of differences which are interesting. We would like to do a little bit more on that. We haven't done. And then I guess let me also answer what Patricia said about like I guess the learning part, which I promised to say. I didn't say anything. When we look at financial mistakes, like for instance, here this misallocated repayment or where is it, like the, yeah, let's say this one, no, or even like the over indebtedness part. So far we don't do, like, I think what would be nice to see would be to see like if this mistakes vanishes over time, the more you use the card as time goes by. We have the problem that the data don't start that much earlier than 2019, and then if we move forward, then we have COVID. So it's a little bit tricky. We try to do something, but you know, I think it's a different paper, but it's an interesting question because I think it's a good setup to understand sort of learning. You can at least look at sort of new originated card, young people. We can look at age, and so to some extent we can try to get. It's difficult for us to. I don't think we are able to identify a card which is the first credit card for an individual, but you know, using the age and card and the age of the card and the age of individual, we can try to get close to that, and then we can see that over time people sort of learn from their past mistakes. Yeah.
Yeah, I think that's super like interesting, and I was really impressed by the paper. And sort of my question was like related to, it's like a general question. So I think the question is like, why is this like a sustainable equilibrium, right? I mean, is it? I mean, you mentioned something in your answer to Pablo. I mean, you said financial education. I mean, there's people that is, you know, not financially educated, but like, yeah. So the other part is learning part, or maybe is this like maybe the costs of you know, making a mistake is very low at the individual level. That's something you can actually show from your data, I guess. But you know, that's the point. Like, why is this like sustainable and in time?
No, because that ties to the question about the learning. I'm not so sure that one would observe a lot of learning, or maybe there is some learning for some people, but for others, I wouldn't. The fact that that is sustainable to me means that there is not much learning, at least in some segment of the market. Also because the costs are not small, and the individual level, the costs are high. I mean, here if you go back to the very first chart, where is it? Yeah, here the monthly level, this guy here is losing $40, and again, low FICO scoring are not that rich, so it's they're very high costs, and you know, it's again, as I said, like it could be the cost of access to credit. It's fine. To some extent, it's true that, you know, people in the US, credit card debt is the easiest way to have access to credit, but you know, like a line of credit costs much less than a credit card. But again, that to me boils down again to financial education. I'm not sure if you ask around how many, you know, for borrowing on a credit card is cheaper. It's not cheaper. It's easier. Okay. And I don't know how many people know that they could somehow switch with not so high cost to get a line of credit of 10K, maybe that then carrying like 4K or 5K of credit card debt every month. But that again goes to financial literacy. Again, statistics, you know, for the US, but for many other countries are striking in terms of like how little financial literacy there is.
I agree. All right. So thanks, Andrea. I think we're just in time. So, oh, there's some.
Is there time for one quick question?
Sure. Yeah, we're gonna have like last one question.
Well, why are you talking about learning? What's the sample period? You're observing just 1 month, right? In 2019.
No, I'm saying that I would like to, as a sort of as an extension of or a different paper. I guess one could, with this data, since this data, no, here we look at the cross section, but we have the data, we can construct a panel, and so we can look at, in theory, what would happen time over time. So we can study learning. I'm not saying that we studied, but looking forward, it's something one could do.
So, but I think we should be cautious about talking just plainly about regulation with its limit the horizon on the data, because my point is something similar to what Patricia said. This is a project position for banks in terms of profit, right? Because they have the low sophisticated guys, low FICO guys are subsidizing the I don't know, this higher works cards. But that position for the banks depends on the state of the economy, right? It's not the same for these guys supposedly more indebtedness. It's not the same scenario when the federal funds rate it's 2% versus the current scenario, right?
Yeah, no, it's true. We are not sort of arguing strongly in terms of like regulation and such. What we are saying is simply that the way the programs are designed, the reward program are designed are a way in which clearly, at least not clearly, I would say our results would point to the fact that the programs are designed in a way that banks tend to attract especially less financial literate people into this reward program. And then on average, those people pay pretty high costs from the program compared to the more sophisticated people. And, as a policymaker, you may want to consider sort of to regulate this program or try to reduce the size of this program if you think that the sort of redistribution from naive to sophisticated is something that you don't want to have. That's the only thing we are saying. Then clearly banks know about that, and banks will adjust and make profits other ways. That's true, but that's the only thing that we are saying. It's far from neutral, like the distribution that is generated by this program.